Welcome back, everybody. We're on the home stretch here of the event. My name is Tom Armstrong. I'm a partner at the law firm of White Summers. I'll be moderator for this panel on sources of capital, angel venture, corporate, etc. I guess. From my script, it looks like the panel sponsor is our law firm. So lucky us. We're proud sponsors of this event, and again, want to thank everybody for attending and participating. For this panel, we've got a great group of panelists, investors. I'm going to mention their names, and then after I'm done with that, each of them can give a little bit about their fund or their group and their background, and then we will start in on our discussion. So on the panel, we have Chris Medina of Tezzeret Ventures, Kenneth Goodwin of Genesis Ventures, Marissa Fayer of Her Health EQ, and we're lucky enough to have not one, but two Mike Roses. We have Mike Rose of Montage Capital and Michael Rose of Better Food Ventures. So to get started, Chris, why don't you let the folks know a little bit about what you do and what on sources of the capital and what you bring to the table.
Happy to. Thanks for doing this, everybody. This has been such an exciting and eventful day, and I've just made so many awesome connections. Tezzeret Ventures is a venture capital firm and accelerator that specializes in operational support. Basically, we earn equity and fees in companies by providing fundraising, go-to-market, customer development, and product engineering services. We're actually raising our very first fund to invest in early-stage opportunities. We're raising a $12 million fund for that. And for Series A plus opportunities, we're raising syndicates on a deal-by-deal basis.
Perfect. Kenneth.
Yes, Ken Goodwin of Genesis Ventures. We are also a venture capital firm. We're also an advisory firm. Essentially, we are also raising our first fund, and the fund is going to be one of the four digital security token offering fund. And essentially what we're doing is we're using a token, going licensed through the Security Exchange Commission using the Reg D. The actual amount will be about 100 million. Basically on the Reg D, particularly the token is going to be probably value using anywhere between a 6 to 7x. So it'll probably be traded at between 600 to about 800 million on the registry exchanges. We pretty much advise and invest in companies within the seed and reg in the Series A level. And these companies we call them digitally transformed. So essentially we look at companies that are very, very data intensive. Companies are in fintech, redtech, AI, and of course, blockchain enterprise solutions.
Great, thanks, Ken. Marissa, why don't you go next?
Hey, everybody. Marissa Fayer. I'm actually representing Assiduity Capital here. I am also the founder of Her Health EQ, which is a global nonprofit focused on women's health in developing countries. But for Assiduity Capital, we are as well raising a fund, our first fund, and it is a $50 million. Our first fund's going to be $50 million. We invest in startups, Series A, potentially Series B, companies in the healthcare space in Africa. And so we are a Netherlands-based organization and company, and so we're putting in between $250 and $2 million in companies. They could be based in Africa, they could be focused and are in markets in Africa, and so they have to be solely based in health. And we also are very patient capital, so we're willing to take our time. We actually also have an advisor network who's going to help and grow these companies alongside the founders and the management team, and that's really what we look for.
Terrific. Mike Rose of Montage, why don't you go next?
Great. Hello, everybody. Mike Rose. I am founder and managing director at Montage Capital. We are a 16-year-old firm. We are really what we call a growth debt lender. So we provide capital of $500,000 up to about $5 million to early and mid-stage companies. We have two active funds. One is a sort of growth-centric fund that's a continuation from our first fund, and then we launched in 2012 a social impact fund. So we have a couple of buckets of capital from which to deploy. And really what our capital is used for is largely as an alternative to equity. So this is for companies that are looking to sort of get to the next set of milestones, or they're looking at diluting themselves a little bit less if they have existing venture. It could be used for acquisitions, a number of different factors. We've done about 160 companies since our inception. We are based in Silicon Valley. I've got one other partner here and then one in the Rocky Mountain region. So thank you for having me.
Great. Thanks, Mike. And last but not least, Michael Rose.
Thanks for having me today. So Betterfood Ventures, we invest in entrepreneurs that are leveraging digital technologies to meet the challenges in our food system. We're primarily a seed investor, and we invest all across the entire ag and food value chain. We like to say soil to stomach. And give you an idea, we've invested in a cloud-based nitrogen optimization service that producers use to determine how to use nitrogen more effectively and less of it in their fields, all the way down to a company that's using AI and omics to categorize and manage chronic inflammation in individuals. We're based here in Silicon Valley and have 11 companies currently in portfolio.
Terrific. All right. Well, one first thoughts I had when I saw this group. First question I have, or want to hear comments on, is what are the most common mistakes you see founders or entrepreneurs make when they come to you looking for capital? And maybe on a positive note, then what could they improve, or what can they do to improve their access to capital and sort of gain your trust in order to get capital? Chris, why don't you start out?
Yeah, I'd say a lot of the founders that we work with feel that they don't necessarily understand the terms that they're being provided or being asked to review. I think that's kind of a common problem. It's kind of hard to understand a lot of this jargon some of the times. And two, I think a big mistake a lot of founders make is not asking their investors really hard questions about value adds that they can provide outside of their capital. Given that that's what our firm focuses on, we provide a wide range of services, from product to go-to-market and customer development. But I do think that when you're taking somebody's money, you should be asking what else they can do for you besides introductions to other capital managers and other VCs, especially if you're raising an early stage round. I think having those connections that are going to be helpful, where those fund managers can make introductions to potential customers, can help get you in the news. I think being more strategic about value add is something that founders should be looking to do.
Sure. Marissa, any thoughts that you have on that?
Yeah, I mean, I think that everybody should know who they're talking to. So, if you're in healthcare, don't talk to an agro fund. Make sure you're very specific on who you're speaking to, and do your research. You don't have to go in like a crazy Google search, but do your research on the firm and in the fund and what they're interested in, and maybe some past investments that they've done or other things or places that they spoke at, and kind of understand what they're looking at. Also, match up the level. So if a firm is only investing in, seed round or Series A, don't come at them with the Series D. Making sure that there's an actual match for what you want and what they actually do, because then you're wasting everybody's time. It makes you sound unintelligent, and they might love what you're doing and be unwilling to make an introduction because you've done no research. It is a numbers game for sure, but make it an intelligent numbers game as opposed to just, you got to put 100 people on the list and check them off to get your one investment.
Sure. Ken, what do you think?
Yes, I was just trying to listen in to the rest of the panels respectfully, but from our experience here in New York City and Wall Street and around the world, one of the key areas.
Ken, there you go. Ken, you're back.
That's good. I'm glad to hear this. There's two actually. It's really two. One, definitely the executive summary tends to be a challenge, and what we tend to see is that a lot of the founders are not very precise as to how they want to use the money, what they want to use the money for. And the other area is relative to their revenue generating model. and that's part of their storytelling. A lot of the founders tend to focus on valuation, and granted, everyone wants to default back to the discounted cash flow valuation. But when you look at a technical or digitally transformed firm, it's slightly different in terms of the matrix. So we're very data intensive. So we go back to intellectual property, the ownership of intellectual property, how you value that, and whether you can add that back to your valuation, and whether you can actually use that as a way to increase the amount of cash flows that you get. So that's why we say we want to manage capital and we want to seek liquidity. And we also understand that money and liquidity is just energy. So that's really the key that we want to focus on with a lot of the founders. Understand your playbook in place, in terms of the actual ask for your executive summary, but then also at the same time, also have a very concise way of actually looking at your intellectual property for your valuation. This will help you out in the next.
Okay, Ken, you dropped off for just a bit, but I think we got the gist of that answer. Let me, Mike Rose, what your thoughts on that? Mike Rose of Montage.
I think I've got my mic off. Can everybody hear me?
Yep.
Yeah. I'd say three things in terms of mistakes that we see quite frequently. One is, entrepreneurs or founders that are too focused on the product, the tech, instead of being focused on the business. So somebody mentioned acronym, we call it the acronym alert when entrepreneurs come in and you have no idea what they're referring to, and they just really get hung up in that space. I think the other thing is just not being, adequately prepared. Somebody mentioned doing some background on who your audience is. That's quite important. And then I'd say the third thing, which is almost in a very high percentage of deals we pass on, is lack of preparedness on the financial side. So entrepreneurs tend to underweight a good financial model and margin forecasting and things like that. And if you don't understand really the nuts and bolts of financial statement construction and that sort of thing, you need to find somebody who can help you with that. Because if you're going to request capital from a professional fund manager or anything else, they're going to want to know how much capital is going to take, what kind of returns can I expect, so on and so forth. I'd say in terms of areas where they can gain trust, I think for us, one is being very transparent and honest. I think that's, don't try and sort of sugarcoat things. If, obviously you have to be positive and have a marketing spin, but being dishonest is quite a different way of doing things. And then also to just ask thoughtful questions of the people you're presenting to, when you get to the end of sort of your pitch about their process and things like that. We always appreciate when entrepreneurs are, thoughtful about understanding our business and how it works, because that obviously could impact, their timeline or anything in terms of achieving their financing objectives. So those are some of the things that we think about.
Terrific. Michael Rose, any thoughts on that?
Yeah, I would echo. Well, first of all, I would just say kudos to all the entrepreneurs and people who are doing startups. It is really hard to do, and it takes. It's great that they do that, and they don't get enough credit for that. I would echo Marissa's point about alignment. We see that a lot of times. People haven't done the research, et cetera. But I would move even further into the process, which is who you're pitching. If you're going to pitch venture, is this really a venture business? And there's nothing wrong with not being venture-backed business, right? If it is a lifestyle business, it is a small business that's going to grow at a much slower rate. That's okay, but that doesn't mean it should be venture-backed. And so I think they need to ask themselves those questions very early on.
Great, thank you. Next question I had, and this is maybe somewhat generic, but what do you look for in a founder? And let me maybe add to that. Do you invest in first-time founders? And if you do, great. or is it that you're looking for somebody who's done this a couple of times? And how do you ultimately make that decision between the type of founder that you want to put your money and trust in? Why don't I start with Chris?
Yeah, I'd say the biggest thing that I look for in a founder is whether or not I'd want to be in the trenches building the startup with them, because a lot our model is opening deal flow through operational support. We do a lot of our work with our founders directly in the trenches with them, whether it's building an app or improving the back end of some tool that they're using, or helping them with a fundraising deck to raise $30 million. We're helping them directly through these deliverables. So that I'd say that's the biggest thing that I look for in a founder, whether or not I want to solve this problem with them, and whether or not they'd be the type of person that I'd be willing to put sweat equity into, as they're trying to achieve their metrics and scale the company.
Okay. Ken, what do you look for?
We also look at sweat equity. We do invest in first-time understands. I do have first question. We prefer that the founder they have access. We have we do invest some experienced founders because we do a lot of work with overseas markets. Where we work with the founders in terms of segmenting those marketplaces and helping our product development. But we get back into the core, what we call MVP, mission, value, and principle. And this goes back into building the actual founders themselves. Is the avenue of having that human relationship. So that's really important. Making sure that they understand their mission, making sure that they have their values and their principles in place, and also making sure that they have some kind of corporate structure in place as part of the governance. So we want to also get an idea when they do have this communication with us to be able to tell us a story about not just the matrix, because anyone can do matrix, because anyone can calculate. Not the matrix, you can do matrix. But how are you able to build your board, and how are you able to bring in the types of people, types of board mix that's going to help you to go on this journey? So we go back to the MVP. That's very important for us. We understand that with a frame.
Terrific. Marissa, your thoughts?
So for me personally, as a founder as well, in addition to, so yes, funding for sure, first-time founders or second-time founders, but for my perspective, we always look for, especially at Assiduity, passion and dedication. And you can hire accountants, you can hire a lot of different people, you can hire logistics managers, you can hire people in supply chain, you can hire those people, and you can find great people. So we look for passion and dedication. We also look for humbleness. Like, as a founder in Africa, most people are going to be first-time founders, or of companies that haven't been funded, or many companies that have failed because there is just a lack of funding structure there. And so people are humbled to say, listen, great idea, have no idea how to get into this market. We're doing great in Kenya, have no idea how to do it in Nigeria. And so are willing to work together with other people. But if there's the passion, they know the market, they understand the product, they understand the need. If from our perspective and from mine personally, everybody else can be hired.
Mike Rose of Montage.
Yeah, I'd say four things that are really important to us, not necessarily in this order of importance, but tenacity and what we call scrappiness. That's something that we look for in any entrepreneur, whether it be first time or serial entrepreneurs. I'd say experience or expertise in their vertical, in their domain. So we do tech, we do consumer, we're pretty open in terms of the different verticals we pursue, but we definitely want the entrepreneurs to have some area of expertise. I'd say another key one is are they coachable? Do they, will they listen to, some ideas or thoughts from not only, a partner like us or, board members or other advisors, to the company, service providers and whatnot. And then I'd say probably the last one what I mentioned is, are they able to recruit other good people? So if you have a great entrepreneur who has skills and so forth, if they're unable to sort of bring in other talented people, often these enterprises can't succeed. So those are sort of the four things that stick out in my mind as being important.
Yeah, thanks. Yeah, Michael Rose, anything you wanted to add?
I would agree with the comments that were made. Persistence is really important. You're going to hear a lot of no's out there, and you have to kind of push through a lot of doors. But the other thing I would add to that is, the fundamentals of doing market research. We see this sadly a lot, or had in the past, in ag tech, which is a lot of people drank the Kool-Aid of Steve Jobs and think that I can develop the product that the customer wants but don't know they want. But there are farmers an hour away. You need to go talk to them before you develop your product. You need to do your customer research instead of developing it in a vacuum. We don't see this in most industries, and we shouldn't see it in ag tech either.
Okay. Let me ask you maybe something more current topic is to what extent the pandemic, COVID, has affected your businesses and your funds. And sort of related to that is, how do you make these decisions where you read about funds that have made investments without actually physically meeting the entrepreneur? It's been done all online. So I'm just curious how each of you are navigating that process at the moment. I'll go reverse this time. Michael Rose, I'll let you start out.
So we have done a number of investments during COVID, and I don't think obviously we couldn't have done this without Zoom. So you spend a lot of time online. It's as close proximity you're going to get to spending physical time with the entrepreneur, and we really haven't had a choice. I would say and that change is, I think that the networking actually has gotten better. In this environment, people who I think have become much more willing and open to connect and share and interact on a digital platform remotely in this environment. So.
Just curious, Michael, has it changed, or are you willing to invest in a larger geographic area given the fact that it's all online?
No, no. I mean, the issues of investing overseas and being incorporated in other countries and currency trades, all those things still exist. That's why we've stayed here in the United States, and we've always looked at deals all across the United States. So that hasn't changed for us.
Yeah, Mike Rose, just curious how COVID's maybe affected your process. Maybe add to that, are there any ways that you think entrepreneurs could, I don't want to say benefit, but can use, to their advantage, the fact that it's maybe it's primarily online in the near future?
Yeah, so it definitely affected we had about 30 plus companies in the portfolio. Thankfully, no hospitality, no travel related, no retail, but we did have some exposure to sort of the work from home. Thankfully, most of those companies have managed through that. But it definitely affected it. I would say 2020 was an interesting year because, as bad as the pandemic was, we anticipated that there would be a major pullback in terms of, capital availability. And in fact, if the opposite occurred, $2 trillion was invested through the PPP program. And so thankfully, a lot of companies, had access to that, but that was something like 75% of our portfolio received over $20 million. So that was kind of a surprise. This year, on the other hand, things have really accelerated, I would say, just because many companies that we deal with anyways had flat or down years in 2020. And so, they don't necessarily, a lot of the government subsidies are waning. And so this year, we're seeing, and a lot of these companies, because their performance wasn't good, they don't want to raise money on a lower valuation, or they don't want to sell, right? They want to wait to get through this year when they have an uptick in performance. And sort of to your other question, Tom, remote, we visit 100% of our companies in person, or did so before, and have done that for 15 years. So it was a big adjustment for us in terms of our process. And as soon as it was safe to travel, we started doing so. So we think, the tools are very, very good in terms of running 90% of your, 80 to 90% of your process. But for us, since we back people, not companies, we like to get out there to the operation, meet the team in person, and get to know them. So as much as the tools are really, really helpful, I would say that we still think business is done, between people, and that's a big part for us. So I don't think I covered your last question, but I'll stop there instead of monopolizing time.
Yeah, Marissa, given your focus on Africa, I'd be curious to get your thoughts, I guess, on COVID impact, and then how you guys go about contacting or working with your entrepreneurs.
Yeah, so we use Zoom a lot, or Teams, or every mechanism possible. But we have for years, just generally, and I've been working in developing countries for many years. I've used Zoom for the past, probably since it was invented. So, and in Africa, it's actually quite accessible for everybody, but it's been quite popular for a very, very long time. So we've always been using sort of digital types of tools, especially for first, second, third meetings. And then eventually, you do have to get there, because I do agree, with what Mike said. You're investing in people, and so you have to have relationships. So, but I mean, with that said, we've done a full investment into a great company throughout the pandemic. We decided to, how we're going to launch our fund as well. So we've done it. What we've been seeing, there's a lot of companies that have changed how they're doing business because of COVID. They're also using COVID as, as we used to always say, like, oh, it's the Uber of something. Well, hey, we're doing this because there's going to be another pandemic, and let's get pandemic ready for the next one. And so a lot of people, rightfully so, on many things, especially related to health, but we're seeing some other things that, they're throwing that in there and trying to relate it to health, but it's not actually health related, or it's nothing to do with the pandemic. Like, you're working on maternal health. Yes, it's a very important, and you need to get pandemic ready, but you're still working on maternal health. Like, it's not necessarily need to be pandemic ready. We're seeing everything go the way of, like, making sure that there's some sort of e-monitoring, because, when that wasn't even part of their 5-year plan previously. And that's something that we started to do. We started to ask them, like, before the COVID, what was your plan? Not to say it wasn't a good pivot, but we wanted to see if it actually, like, was in their thought process before, because e-pharmacies, telemedicine, all of these things, everybody was talking about them. Of course, the reality now, but there's also the risk that in, that in a year or two, nobody's going to be interested any longer, or they're still going to be really interested in it. If there's a background market for it, then that's great. So, we're having the pandemic kind of be both sides of the coin, but from our perspective, we do want to meet people, but it is also hard going to Africa as often. Obviously, we're setting up offices there, so that'll be a lot easier in the future. But things have been over Zoom for a very, very long time for companies like ours.
Ken, impact to your group, the COVID impact, what's it been, and maybe some thoughts on or tips for entrepreneurs, how they can navigate sourcing capital in these times?
Similar to Marissa, I mean, we definitely want to meet people, but we were always doing foreign direct investment for a good 6 or 7 years overseas. So it really didn't matter whether we met people or not. What we saw was that whole digital transformation, going back to Zoom, going to Google's and so forth. here in New York, we're constantly going to conferences and meetings with family offices. So you get used to going to meetings. We just went to one recently with SALT, where I think they had like 2,500 people, including private equity, VC firms, and family offices. So we were used to doing that and traveling around the globe. But what we saw was that nice pivot by companies, and they went data intensive, which was okay. We were fine with that. We were fine with the pivot where it was actually impacting their revenue generating model. That was more important to us. What were you going to be doing next in this type of situation? Are you going to go and look at ways to look at your intellectual property that you have, either via applications or hardware, and how are you going to actually utilize that to create another stream of cash flow so that would increase your valuation? So we were okay with meeting with people online. And then another thing that we did that was really great, we've always been a part of syndications. So we do a lot of work with SOSV, Andreessen Horowitz, firms out in around the globe, and several family offices in Germany, as well as in Switzerland. So that was great to actually share a lot of information. We participated in the first 24-hour VC event that was sponsored by wholesale investors, and that was done down in Australia. So we didn't have to go to Australia to actually have access to the other VCs that came out of Canada, that came out of the Europe, that came out of Asia. We were actually doing it already. So in a way, it kind of benefited. It kind of increased that human capital that's really important in terms of the VC space. We embraced it, and we challenged our companies to actually apply that to their revenue generating model. So we saw firms that were starting to use data management. They would start to use deep learning, machine learning. They started to use specification management. It inspired me to do a TEDx talk on these companies. So I took 9 of the companies that we invested in, and I did a TEDx talk on it in terms of how do you digitize for cross-border trade and cross-border analysis. So it was beneficial for us. We do look forward to meeting with folks. We know that's very challenging with the challenge that we have with COVID-19, but we do feel comfortable with using Zoom, and we do feel comfortable with meeting with people online.
Oh, excellent. Chris, any thoughts on impact of COVID-19 for your fund and companies that you're looking at?
Yeah, well, we actually built out most of our portfolio during the pandemic. So that was, kind of an interesting experience, meeting founders from Latin America and Nigeria and New York and all around the world and all around the country, with the fact of not being able to meet them in person for at least a year or longer. So it's been exciting to have met them for the first time in these last few months. But I think it was also a blessing in disguise in some ways, because I feel like we were a lot more productive, just because we're able to squeeze in a lot more meetings, figure out how to get deliverables done, and ultimately make the connections they needed, whether on the fundraising side or customer development side. And I think the other impact that it had was, a lot of our portfolio companies were in markets that aren't necessarily digitally mature. So the pandemic definitely almost created a bigger market for them sooner than it otherwise would have. Thinking about verticals like ag tech or transportation as well. Our portfolio companies in those sectors really had to think about how to be resilient and how to be creative in their business model, such that they would survive the pandemic and come out of it stronger. So I think when we're thinking about those verticals that had a harder time surviving, the ones that got out and figured out how to innovate, I think are going to be some real winners over the next few years to pay attention to. So as an investor, that's something I'd look for, in the companies that are able to survive in the industries that were hardest hit.
The next thing I'd want to at least get the panel's thoughts on is, I always hear it's more, art than science. I'm not sure what the mix is, but how you, with the companies and the funds, how do you arrive at what the valuation is? And how do you come to an agreement or decide exactly how much capital is going to be put to use? I'm always interested because in all these pitches, you see numbers that are just all over the map. And I'm just curious to get your thoughts on, how you arrive at that, and maybe some tips for entrepreneurs as to how they should think about valuations and the amount of capital that they're going to need. And I want to start with Michael Rose from Better Food.
To your point about it being art versus science, so when we're investing in seed and pre-seed, it is very much, you can run discounted cash flows all day long. The relevance is going to be questionable. What we back into is we look at a number of things. One, how much are you raising, and then what are you going to spend that money on, and the reasonableness of that use of funds, right? We look at the fact that when you talk about valuations, there's going to be a price round. If it's a safe note, there's going to be a round after this, and what valuations are going to be. We've invested in companies that then immediately jump to very high valuations, and the challenge is they have to grow into it. And they're going to have to raise money again, and you don't want to have a down round. So it's a number of those factors that we look at.
Mm-hmm. And any tips for entrepreneurs as to how they should be thinking about this or be ready for that discussion on valuation?
Well, we also look at comps, right, in their sector, and so I think they need to educate themselves about and that's a double-edged sword, because on one hand they will look at other companies and they'll say, well, that's how much they raise. And and they get excited about that, but that may not be your company, right, and your needs. So I think you do have to educate yourself about the marketplace.
Sure. Yeah, Mike Rose, I know with Montage, you guys are a little, not investing in the pure startups, but curious how you guys go about figuring valuations and amount of capital to put to work.
Yeah, in terms of the dollars, our business is really, we don't, we look carefully. I mentioned financials earlier. So when we're looking at the financing round, we're looking at how much capital is it going to take the company to get to what we call self-sufficiency. So what that means is, we definitely back pre-profit companies, but what we don't want, we're not a bridge lender. So we're not financing the company to get to the next round. And so for us, it's important that the operating model is realistic enough that our financing gets them to a point where, yes, they can raise some more capital if need be, or they can operate the company based on their existing customers and so forth. So it doesn't sort of risk the enterprise value of the business. So that's how that's pretty simple math in terms of looking at the model and that sort of thing. And in terms of valuation, we're not an equity fund. So, we're really looking at either the last round valuation as a metric to use as we price warrants, because we do take sweeteners via warrants. Or we'll look at a 409A or the price at which, the team is issuing options in the pool. So that's how we think about that. And we're generally trying to save, the company's 75-80% dilution relative to raising pure equity. Last thing, tips on valuation. I think, when we talk to entrepreneurs about, existing portfolio companies and what they're doing for their next rounds or whatever, we just advise them not to be too greedy when it comes to, especially in markets like right now where we're at all-time highs. So, it's more important to get the right partner and board member and the right firm. And, don't be too greedy. That's really our philosophy there. Get the right amount of capital to execute on what you need to do. And there's a lot of money out there. So, don't get too hung up on valuation. That's the thing that we typically say.
Yeah, Marissa, how do you guys approach valuation and amount of capital to put to work?
Yeah, very similar to what both Mike said. We just figure out what makes sense, what it's going to do in the future. And I agree, don't be greedy. Build a good company, the valuation will grow. So that's kind of what we think. And having comps is really important. Use experts in the field, people who have maybe done this before, who've built similar companies, and could advise potentially, especially as we're typically dealing with younger founders, or founders who haven't done this before. This is actually help that they need sometimes when they're coming to us. As far as amount to put to work, it's based on how much we can also add as a value add. So, if we think that we're going to be doing a lot of operational work as well as investing capital, that might change how much capital we put in, either higher or lower, because we think that we're going to be investing a certain amount total, whether that's we've put 4 experts on the field, on the ground as well, to help build this company and some capital. We try to lead at least 50% of our investments. So, we like to not invest in the same thing, in the same market, in the same industry, in the same vertical, multiple times, because then our companies are actually in competition with each other. And as it's a relatively smaller field, we like to diversify the portfolio quite a bit, so that they could be similar, they could be complementary. We don't need them to be in direct competition to each other. That actually is sometimes hard for us to potentially manage. But those are things that we decide. And also, we're investing in companies in Africa. In reality, they know how much they need. You're not going to give a startup, somebody who's just going for a seed round, $2 million. Nobody would even know what to do with it. Like, you can't use that money. Like, there's not enough things to invest in or to work on at that point in time. If a Series B company is coming to us and saying we only need 250, I think that's a little bit like we need to have an actual discussion, because you might not actually understand your business as well as you think that you do. So those are the kinds of discussions. Most of the time they know exactly, and there might be times where we have to say, guys, like, you're asking for $254,000. Like, maybe let's put that at 300. Something like that. Like, you don't need to be exact to the dollar. Let's understand that there needs to be like a little bit of extra in there to account for something that's, that might happen. Yeah. So yeah, I think just having the conversations as well, and looking at what makes sense.
Yeah, Ken and Chris, anything you wanted to add on your approaches to valuations and amount of capital to put to work? Ken, why don't you go first?
Yeah, we're slightly different. We don't go back into the traditional discounted cash flow model. I know that a lot of firms tend to rely on that. They definitely rely on asset valuation, historical earnings, and so forth. And here's why we don't rely on that: because several of our companies they use tokens as a way to increase the enterprise value. So we have a very unique approach there. We go back, we kind of turn it upside down. So let's look at your statement of cash flow. How well and then we do a ratio analysis from there. And then we focus really on their statement of works that they have in place. We look at that as a valuation. And because of these companies are digitally transformed, a lot of these companies do have intellectual property. So we do add back that as a valuation for it. What's significant to us is that asset valuation, that whole asset valuation, the ability to manage your liabilities. We don't like to have double leverage firms in place. We know that's going to be a challenge for not just the first round, but also the second round. So that asset valuation is very key to us, but also what you have in your pipeline in terms of your statement of work. So we realize that companies, they may not have the revenue yet in terms of recognized revenue, but they do have statement of work that do add value. So we look at those particular factors in place. We rather for firms to take a very conservative approach. We know that people like to jump on a 10x, and we also see people jumping on 15x. We don't think that's very realistic. We rather see firms that go at 3 to 5x. That's what we like to invest in. And then from there, we kind of work towards the next round. So we're very, very conservative in our approach, where we like to look at the entire enterprise valuation. That includes both the intellectual property. In the case of tokens, different, because token valuation could change, right? Because you have challenges with tokens. So there's that room where you have a lot of mismatch risks, option risk, basis, yield curve risks. So you have. So we're very conservative, but at the same time, we understand that we don't want to have high valuations.
Chris?
Hey, Tom, this has been a great session, but I think we need to move to wrapping up here.
Okay. Well, I want to thank everybody, all the panelists for participating, all the attendees. Thanks so much. And it's been a great event. And again, hopefully people found that of value, and I wish everybody good luck in their quest for sources of capital.
Yeah, and I want to say thank you very much to the panel. It was very, very informative, and a huge thank you to Tom. I think you ran this panel really, really well. Great questions, great information in here. Thank you all very much.
Thanks.
Appreciate it. All
Thank
right,
you.
so now we're going to move to close, and I think Mary Jo is going to share some slides with us for closing. There we go. All right, so that brings us to the end of the program for this year's Startup Investment and Community Capital Expo. We've heard from a wide variety of companies, from farm kitchens to solar energy companies, wine cellars to new search engines, indigenous tourism, companies that help fund musicians and social projects, companies that help farms grow more productively. We've also heard about women in venture capital and Latinx entrepreneurs, sources of community capital for startups, and in this last session, venture capital for startups. All of these are helping entrepreneurs define and conquer the new frontiers that our changing world makes possible. It's been a rich day and a long day, and I thank all of you with the interest and the dedication to join in for the day. Next slide, please. The great content from all of these talks, panels, and pitches will remain accessible on this event website. If you sign on at expo.siccmonterey.com, that will remain live for at least the next year. So come back often and bring your friends. Next slide, please. I want to thank the amazing committee that put together this event, and I particularly want to thank the IIED staff, separate from myself, who worked incredible hours putting the event together, led by Mary Jo Zank, who during the day has earned the title of captain of the ship, and Lynette Lathrop, who has been working tirelessly behind the scenes to find all the missing people. So they have been working not just through the day, but through the last several weeks to get this put together. We want to thank, next slide, please. We want to thank the Economic Development Administration, our silver sponsor. Next slide. We want to thank our panel sponsors for their support, Cal Coastal Small Business Development Center, the White Summers Law Firm, Solari Holdings, and the Pearlworks, and our general sponsors, UC Santa Cruz, Wild Plum Cafe and Bakery, Pinnacle Bank, Union Bank, Bank of America, and 21CM Digital Marketing. Next slide, please. Thank you to our media sponsors, 90.3 KAZU, the Monterey County Weekly, and our marketing partners, Santa Cruz Works, Monterey Bay Economic Partnership, and Slow Money, Northern California.